Hello, John Neyland here. We've got an update. It's been a little while since we've had one, and we've got a very power-packed presentation today. Before we get started, I wanted to introduce some of the staff that you may or may not be familiar with. And I think everybody knows Alex Bernal, baby girl Olivia in the bottom down there. But this guy on the right-hand column is a big part of our engine that we do a lot of our research with. So I would like Alex and Dave to explain really what they do together and really what gives us the intellectual edge. So, Alex, you take it off, and then Alex and let Dave finish up and introduce himself.
Absolutely. Yeah. Thanks for coming, Dave. He works behind the scenes with us on mission critical technology. He's been working with us for many, many years now. We dragged him out for a few speakers bureaus maybe 4 or 5 years ago. And so we're happy to have him and reintroduce you to all of our clients. Dave is technically, you would say, the CTO, Chief Technology Officer of the organization. And remind all our clients, we build all of our technology and databases in-house, and we do our own research. And so this is why it's really important to understand who Dave is, what he does, and how he works within JCN. Go ahead, Dave.
Hey guys, David Bergstrom. I've spent the last 15 plus years in the professional trading and investing world. Deep quantitative experience working with hedge funds, high frequency trading firms, and market making firms. Spent many years researching, building, and testing systematic investment processes and institutional grade risk modeling to help hopefully limit drawdowns, analyzing portfolio interactions, position sizing, etc. And as Alex mentioned, we do all of our technology in-house, as he said, part CTO, part dev team. And now with modern technology, we're able to do what other companies do with teams of 10 or more, really with what you're looking at here. So as always, thanks for having me and look forward to building something great.
Yeah, and Dave, I appreciate your help over the years. We've had really good results, and certainly Alex deserves a lot of applaud for that. But you deserve your share as well. Today, what I want to talk about with our clients is something I think is quite interesting, and that is volatility. I've noticed over the years we can have a 30% gain in the market, and you don't in our returns, and you very seldom hear a word about it. But right now we're having some volatility in the marketplace. It's relatively small, but I want to put in perspective what we expect and what's happening. And more importantly, what do you do, if anything, when there's volatility? So to try this shirt on for size, the market will have a 5% drop 2 to 4 times a year. It'll have a 10% drop about once a year and a 20% drop about every 4 years. So therefore, it's somewhat expected. So the question is, what, if anything, do we do? Because people often say, well, John, what you going to do? Well, the first thing is nothing. If we've got very, very good stocks, we want to keep those very good stocks. So Alex and yourself and Olivia look at the fundamentals of these stocks, which is what are their sales, what is their growth, what are their earnings, what's the free cash flow. If those dynamics are rising, we want more of that stock, not less of that stock. But at the same time, Alex and Dave do something else, and Olivia is very important. We really take note during these times. And what we find is this: we may be able to find a stock that is super, super strong, that's price is going down. So what would you do then? If you had a really great stock, all the fundamentals are strong, maybe stronger than before, and the price is going down, that's when you buy low. Just because the price is low doesn't mean it's a good value. But if the fundamentals are strong, we're there. So we're doing two pretty important moves tomorrow. And I want Alex to talk about what we're doing, why we're doing it. We've also want to share what's taking place in the marketplace that's good for us. Now we're taking advantage of that, and what's really fueling most of the growth we've seen in the market right now. So, Alex, without any further ado, I'd like you to take the helm and share our information here.
So, yes, this is our midsummer update. We haven't done one in a while. Thank you all for attending. The first slide is really important. We were just talking about volatility, and I saw Merrill Lynch publish this to all their clients, really reiterating what we already just described, but it's important to understand what is normal volatility so that when the markets, which go up and down every single year, are experiencing that, you don't make an emotional decision when it's something that's normally expected to happen. So, on average, the average drawdown since the year 2000 for the S&P 500 is around 24%, or excuse me, 16%. This is on average what you should expect the market to dip in any given year. Now, some years it's going to be more, some years it's going to be less. The smaller corrections are expected as well, less than 10%. And this is what they sent their clients with the key consideration at the bottom. During volatile times, periods of weakness may provide attractive buying opportunities for investors to add to their investments. So this is exactly what we do. This is exactly the approach that we deploy, is when you get something on sale, it's a great opportunity to buy. What is driving this? So the biggest theme that is playing out that we caught on to in a big way the end of last year is the power demand for AI. AI is getting built out at a rapid pace, and the demand side of the equation is tremendous. It's expected that the power needed at a minimum, and they keep raising this, by the year 2035 is over 253%. And this isn't just like software. This isn't just like, other technology you can just boot up. These are real physical power generation equipment and the transmission lines and the generators and the converters. This is real manufacturing that needs to happen to achieve this power goal here in the United States. So this will continue for many, many years, if not decades to come, because the demand for AI power is essentially insatiable. And there's a lot of talk right now in the media about how this could be a bubble. Well, we never know if it's a bubble or not, but if we were to look at the internet bubble back in 2000, the biggest difference between then and now is back then there was really no fundamentals. So the prices were going up and none of the stocks had any earnings, had any cash flows, had any book value increases, had any sales. So to me, that's not the same comparison, because right now you can see it here in the data. The left-hand side is the earnings for the S&P 500, which are at an all-time high right now, and they're supposed to accelerate into 2027. So they're not only going up, they're going up at a faster pace than it has in the last few years. That is what we're seeing in the fundamentals. If you look forward, which analysts can estimate fairly accurately, beyond 2027, 2028, 2029, 2030, the hyperscalers, the companies that are building out these data centers, their free cash flow is expected to explode upwards, skyrocket. So this is the type of thing you need to be aware of when you're looking at the fundamentals, is what is sort of the expectations around this. And so we want to position ourselves to take advantage of this when it plays out. This year, it was really important for us to take a look at what's going on under the hood. In terms of the fundamentals this year, the key sectors that have seen the most growth are energy, technology, materials. Basically, the three sectors that are building out the AI infrastructure. Everything else is up a little or flat. And so this is the type of thing where technology is leading the way, and we should expect the other sectors to take advantage of the technology once it gets built out. So those are the strong sectors. Inside those sectors, the semiconductors, actual microchips, they're expected to be about 50% of the earnings growth. So half of the S&P, half of the profits they made are literally in the chip companies only. So this tells you how isolated the growth is at this stage, is that most of the gains right now in profits, earnings per share, is in the chip companies. So when we're looking at companies to buy, and we maybe go back one slide, what do you think are the best areas to go shopping? Energy and chips, right? So when we're looking for something to buy here in this volatility, the first company that has tremendous upside in terms of their fundamentals and their forecasts is Marvell Technology. Again, they're in the memory chip part of the sector, semiconductor sector. They were up 230% this year at the all-time high, and they're currently at a 40% drawdown. So they're trading at a 40% discount. At the same time, their revenue is supposed to go up about 3 times from here between now and 2029. So that's a great company that we're looking to add to the portfolio. We will sell MSCI, which is an index financial company, to make room for this position. The other position that me and John have been watching since the early part of this year, we just wanted to prioritize other energy companies over Bloom. But in hindsight, I wish we would have bought it back then, but it's up 760% at the all-time high. And they just reported earnings yesterday. Again, their revenue is supposed to go up over 3 times between now and 2028. So Bloom Energy is special because it makes these natural gas converter machine boxes that you can put on site at the data center to convert natural gas to electricity, and it does it in a way that's compliant with a lot of emission standards. So the CEO had a really great bullet point in his presentation yesterday in the earnings call. He said, "You can't put a gas turbine in Manhattan." And I was like, that's actually a really good point, because in those densely populated areas, they have strict air control quality standards. So this is the type of technology that helps with that. Any thoughts, John?
Yeah, I want you, Alex, back to the sectors, how they're performing this year. Now, this is a conversation on what our clients really do. We have to really retrain our thinking, because you've been trained as a consumer to follow something that doesn't really make sense. In my opinion, the world's greatest investor is Warren Buffett. He's adamantly against this. But you hear this on the lips of people every day. We need to be fully diversified. So if you took these asset classes here and you fully diversified, you wouldn't make as much money as if you invest in the stronger horses in the race. So right now, we're not going to put everything in one spot, but the areas that are given the greatest turn is where we're going to be. And we're not going to be fully diversified. We're going to be buying the stocks that are the best values, that the greatest growth and greatest potential going forward. And that's how and why for the last 10 years, we've had the returns we've had.
Great point.
Dave, would you have anything to add to that?
No, I think from a systematic approach, we just follow the system and go where it goes. But I mean, yeah, volatility is part of the journey, and looking to capitalize on it is always opportune.
Volatility is a key word, because our clientele need to understand something. We're looking for stocks that are rising real fast. That's volatility, isn't it? Movement. Well, you can't get in that kind of vehicle and not expect the volatility downward to be fast as well. It's going to be volatile both ways, but in the end, we do better on that ride up. Now, you and Alex and me and Olivia have got elements in our portfolios, such as our structured notes, that over time have no volatility, and that's how we mitigate the overall risk and volatility of our portfolios. In conclusion, things look very good for us and you. I think we'll continue going better and better and better. And going forward, I would like for us to take some time out every month to do a presentation on topics that are of great interest at that time. So real proud of the job everybody done. Olivia, Alex, and Dave, fantastic job. And we are doing something different here. And I see this every single week, y'all, in our office. So Alex, you and Dave aren't aware of this, but every single week people bring in their statements, other that are our clients, and we analyze them, and they're not meeting the market. They're underperforming. And we've done a good job on performance. So it's the work everybody's put into it, and greatly appreciate it. All righty. Well, until next time, y'all have a good day. Talk to you later.
See ya.
Bye.
Bye.